Welcome to Talks with Dr. Gupta and friends. Today we break down a major structural shift in global capital markets, the unwinding of big tech stock nicknames and the emergence of a new institutional technology thesis. For years, retail and passive investors leaned heavily on market monikers like the Magnificent Seven, Nvidia, Meta, Apple, Microsoft, Alphabet, Amazon, and Tesla. By 2024 and 2025, these seven companies commanded over a third of the S&P 500's total valuation, functioning as forced buy targets for passive index tracking funds. However, the summer of 2026 exposed a critical flaw in treating these disparate companies as a single homogeneous collective. The group shed over $2 trillion in market capitalization in June alone, after investors confronted the reality of spiraling artificial intelligence capital expenditures. Across 2025 and 2026, the four primary hyperscalers Meta, Amazon, Microsoft, and Alphabet committed over $1 trillion to AI infrastructure. This unprecedented spending spree outpaced earnings and cash flow, forced a reliance on corporate debt, and saw operating margins squeezed by rising component costs like high bandwidth memory chips. Market history shows that stock nicknames are classic indicators of momentum-driven market concentration. Just as the Nifty 50 blue chips of the 1960s, including Kodak, Polaroid, Avon, and Xerox, eventually collapsed when momentum reversed, market concentration creates systemic vulnerability. Research by Paul Woolley and Dimitri Vayanos from the London School of Economics shows how passive index tracking and benchmark pressures distort stock prices, forcing fund managers to buy overpriced megacaps. To exploit this disconnect, hedge funds have actively unbundled these trades, taking long positions in semiconductor manufacturers while shorting debt-burdened hyperscalers. To build an actionable tech thesis, we must analyze the structural mechanics of technological bubbles and capital allocation. Throughout history, from the South Sea bubble to the British railway mania of the 1840s, transformational technologies triggered speculative frenzies that led to massive overbuilding. While 6 planned rail lines between Leeds and Manchester resulted in initial financial ruin, the resulting physical infrastructure ultimately transformed the global economy. As financial historian Edward Chancellor and GMO founder Jeremy Grantham note, productive capital carpet bombs a new sector during bubbles, accelerating technological adoption despite the initial financial wreckage. Today's market displays similar speculative architecture through derivative vehicles, such as single-stock leveraged ETFs. This was highlighted by SpaceX's volatile public debut, which spiked from its $135 IPO price to $225 before falling below $135, and the destabilizing surge of single-stock ETFs in South Korea, tied to Samsung Electronics and SK Hynix, emphasized the global reach of these dynamics. Yet, as highlighted by the Bank for International Settlements, artificial intelligence differs fundamentally from past general-purpose technologies. Steam engines and early computing augmented human labor. Advanced AI augments the production of knowledge itself. If autonomous systems can iteratively generate new scientific ideas and software tools, the macroeconomic outcome could unlock compounding, super-exponential growth. The market conversation has already shifted toward new acronyms, such as MANGOS, referring to Meta, Anthropic, Nvidia, Google, OpenAI, and SpaceX. However, replacing one nickname with another fails to resolve the underlying institutional challenge, identifying which layers of the technology stack actually extract durable economic value. To navigate post-MAG's 7 market dynamics, capital must be allocated across 3 distinct operational pillars. Pillar 1 is hardware and compute enablers. Rather than owning over-leveraged buyers, focus on essential silicon, networking backplanes, and memory architecture. Nvidia remains the core compute standard, capturing high-margin GPU cluster demand. Broadcom captures custom ASIC chip design and high-speed networking backplanes for hyperscale data centers. Micron Technology supplies the high-bandwidth memory chips essential for processing complex AI workloads. Pillar 2 is power generation and grid infrastructure. The primary physical bottleneck for $1 trillion in AI capex is electrical power generation and power management hardware. Constellation Energy is the premier nuclear power operator providing clean, baseload energy to co-located data centers. GE Vernova provides heavy gas turbines, electrification hardware, and power grid expansion equipment. Eaton manufactures critical power distribution hardware and liquid cooling transformers required for high-density computing. Pillar 3 is monetizable platforms and concentration hedges. Differentiate between hyperscalers spending blindly and platforms with direct AI yield. Microsoft combines enterprise cloud distribution with direct Copilot software monetization. Alphabet features full-stack integration from custom TPU chips to dominant consumer search distribution. Meta converts open-source Llama AI models directly into improved ad targeting yield across its app family. Invesco S&P 500 equal weight. ETF eliminates megacap weight distortion across equity portfolios. iShares 0 to 3 month Treasury Bond ETF provides risk-free yield and cash optionality to buy quality assets during drawdowns. By shifting away from speculative monikers and anchoring capital in energy infrastructure, chip hardware, and disciplined platforms, investors can capitalize on the AI transformation. This approach helps mitigate systemic concentration risk. Thanks for watching Talks with Dr. Gupta and friends. Stay sharp, stay informed, and let's keep analyzing the forces shaping our world.